There is this financial model that are being used by all the great investors like Warren Buffett, Stanley Druckenmiller, and George Soros, and they sometimes they talk about the model on the media. It's called expected return model. Um, what I like about the model is that it's really simple and it's really flexible. Whether you're a beginner or a seasoned investor, you can all use this model and make your analysis better. So today I'm going to introduce the model first, and then I'm going to talk about how we should be using the model. At the end, I'll give you my personal experience, two examples how to use the model. Okay, so the model is called expected return. So let's say we're going to buy Microsoft stock. And there are two possibilities. Let's say you're going to hold the stock for a year. So at the end of the year, you may make a profit or you may lose some money. So you can profit or suffer loss. And of course, there is a possibility of break even, but it is pretty small. So for the simplicity of analysis, we just gonna ignore the possibility for now. So in this case, how do we calculate expected return for this investment? We're gonna have to do some estimations to make the model work. So let's say we have 80% chance of making 20% return. So this is the profitable case. So that will be 16% expected profit on the upside. And on the downside, so let's say we have a 20%, 80% plus 20% must be 100% of probability of making losing 20%. So now we have -4. So the expected return in this case is 12%. So now you may ask, how do you know it's 80%, 20%, and 20%, 20%? So this is where the flexibility comes from. Let's say if you are a fundamental investor, you're gonna have to, basically go through all the financial statements, balance sheet, income statement, cash flow, and judge by different ratios and make a reasonably estimate of these numbers. But let's say if you're a new investor, you have no accounting knowledge. What you can do is you can go back to the historical data. You can look at the chart, and you can basically randomly pick a period of 1 year, and pick 10 different samples, and average those samples out, and then it make an estimation of those numbers. Well, actually, the initial estimation is not the really important or actually the useful part of the model. The useful part of the model is when you update the model with observations from the financial markets. So a lot of investors, their performance is not good, mostly because they have big losses. And the reason they have big losses is that they do not have a clear investment thesis before they make the purchase. And this will put them in two very dangerous situations. Number one, so when the market takes unexpected turn against your stock and you don't know what to do. And also that you have a theory about stock and it's basically wrong, but you do not know it's wrong. So that's also very dangerous. So with the model, actually, it's going to give you basically a initial investment thesis, and then you can make sense of the observation from the market data. There are all kinds of things happening in the market, so you can verify reality with the model. This is the key use of the model. This is the really important part of the model. So this process basically make you think about the investment twice. A shift from intuition, your instincts, impulsiveness to rationality. And it gives you two filters right away. So the first filter is that there are certain stocks or investments, it's just not possible to estimate. And you just don't have enough information and you just don't know. So that case, you will not be able to make a reasonable estimation of those numbers and you do not invest. So the second filter is that when you have expected return of negative. Okay, now let's look at the expected return, and there are different possibilities. So it may be less than zero, more than zero, or even bigger than S&P 500. So in this case of less than zero, so it's not really investment opportunity. The expected return is negative, and things like buying a lottery, go to casino, those activities all have negative expected returns, and so we only entertain those opportunities which have a positive expected return, and if the return is more than your benchmark, let's say S&P 500 is basically you find something undervalued. And if you look at downside, the downside, so let's say if the downside of your expected return is, let's say the size is less than the downside of S&P 500. In this case, you have a situation that the downside is smaller than your benchmark. You may reasonably say there's a kind of margin of safety built in this investment opportunity. Actually, when you build the model, when you estimate the initial numbers, you need to pay particular attention to the downside. And most investors do not pay enough attention to the downside. The reason is many investors, before they purchase any investment, what they do is they do all kind of simulations in their mind. But most of the simulations are positive. So they basically imagining all kind of different scenarios. What if the investment goes up 50%, in a year? But they do not pay enough attention to the downside. What if the stock goes down to 30% just after you bought it? And the reason being is it causes stress, and our brain is designed in such a way that we try to avoid stress in any possible way. So pay attention to the downside. Now it comes to the really important part. It's the update. And you need to update all your numbers, your estimations, to make sure that you stay ahead of curve. And there are really two kinds of update. You need to update the time dimension, and you need to update according to different events. When the price goes down and everything else is the same, it actually means you have a higher expected return. So the lower the price, you have a higher expected return. And for events, there are normally two kinds of events: macroeconomic events, such as the Fed announcement about interest rates, monetary policy, and fiscal policy, and also like trade war and natural disasters. Those kind of outside external events, and also you have internal events, such as the company is going to launch a new product, and there's a earning miss, and there's a management. CEO is leaving the company, stuff like that. So some events is going to enhance the upside potential of the investment. Some events will basically increase downside risk. So the update is really the most important thing. And this is when you decide to add position or hold on to the position or sell your investment altogether. So if you look at the financial markets from the expected return perspective, all the investment vehicles becomes a collection of expected returns, and you can make a comparison and decide which one you should put in your portfolio. And remember, the expected return, there's an inner structure. So when you do the comparison, you can compare compare the upside and downside. For example, and you have investment, you would expect to return as much as S&P 500 index fund, but it has a lower downside and meaning less risk. So in this case, it's a superior investment opportunity alternative. While you create the model, it's easier if your target is a simple business and the earnings are very predictable and it has been in the market for a long time. And it's just easier because the earnings are very smooth. It's easier to estimate. And for some business, it's just impossible to have a reasonable prediction or estimation of those initial numbers. So now I'm going to give you two my personal experience, my personal stories of using the model. So the first one is that I invested into a company, newspaper company called Toronto Star. It's a newspaper publisher in Toronto. My rationale of the investment at the time that was around 2016 was that the price of the stock is significantly lower than the book value, and so it's a value play. So Toronto Star owns Harlequin Publishing, so the management sold that business to News Corporation for about $350 million, and it paid down all the bank debts and got a bunch of cash on the balance sheet. So I see this, and I know newspaper is declining business. However, because it got so much cash on the balance sheet, the downside actually is pretty small, and the upside potential is quite big if they can turn around the business. So this is what happened afterwards, and so the management decided to use the cash to buy a company called Vertical Scope. It's an internet company, and I don't think the management knows how to run the company. And the newspaper business continued to go down. So at this juncture, what I should have done is to update my initial estimate and reevaluate the expected return of the investment. But instead, what I did was that I did tons of research on newspaper industry and on the Vertical Scope. I came up with a really complicated theory that it's a justified investment. After a couple of years, the stock continued to go down all the way to 20 cents. So I sold the stock along the way for roughly $1 and lost 80% of my investment. And so the lesson of this case is that you need to follow your model with discipline, and don't try to come up with the theory to justify the action of holding a losing stock. And the second case is a positive case. So at the end of 2018, there was a lot of negative news about Apple. First, there's a trade war going on, and the second negative news is that the iPhone 10 was not very successful. So the management gave a warning about their future earning guidance. So the stock went down dramatically. I think it went down maybe 30-40%. So I think these events are all temporary. And I calculated the expected return. There's a very big chance that those shocks are temporary, and they will have more new products, more successful new product launches in the future. And they have a service business which is growing really fast. So I bought into the stock at around $160, and it has been doing really well ever since.